He sent me a screenshot, a setup any trader would dream of. Breakout, clean structure, RSI confirmation, volume spike. Classic, he said. 15 minutes later, hit SL. Market's rigged. But what if I told you it's not rigged? It's rehearsed. What if the perfect setup that failed wasn't a mistake, but a scene in a much larger performance? This isn't chaos, it's choreography. This isn't randomness, it's rhythm. And you've been handed the wrong script. Welcome to the other side of trading, the side no one teaches, where price isn't truth, it's a distraction, where breakouts don't signal opportunity, they mark entrances to carefully laid traps, where the loudest moves are often the most deceptive, and the quietest moments reveal the most powerful truths. This is where your edge begins, not by learning more indicators, but by learning to read the story behind the price. To stop acting like a trader and start thinking like a director, because in this game, the one who understands the script never needs to predict. It always starts the same way. The chart lines up, resistance breaks, volume spikes, RSI pushes past 70, everything, absolutely everything screams go, and so you do. You click buy, you lean forward, you feel a shot of dopamine light up your chest. This is it. This is the one. But before you can even settle into the trade, the candle turns red. Fast. One more red, then another, and just like that, you're stopped out. Reversal, loss, silence. You stare at the chart, confused. You had confirmation, you had structure, you waited, you followed the rules, and still it went against you. This wasn't a mistake, it was a scene. And you were part of the cast. The market isn't random, it's designed, and some of its most powerful designs are built to look perfect, because perfection is the best bait. Let's get precise. Picture this. EUR/USD, H1 chart, London session. Last Tuesday, price had been stuck in a tight 30 pip range between 1.0850 and 1.0880 for hours. At exactly 8 a.m. GMT, the breakout comes. A massive green candle tears through resistance. RSI spikes to 72. Volume triples. Twitter exploding. EURs breaking out. But what nobody noticed was the trapdoor underneath. That 1.0880 level, it aligned perfectly with the previous week's high. A textbook liquidity pool, a place where smart money had been waiting patiently for days. The breakout wasn't the beginning of a trend, it was the climax of a scene written in advance. Buy stops were triggered. Retail traders piled in, and just as quickly, 2 candles later, the entire thing collapsed. Price dropped 80 pips in 15 minutes. Every buyer trapped, every stop hit, every late entry punished. And the smart money, they didn't just win, they orchestrated it. If you've ever been caught in one of these, if you've ever seen a clean breakout reverse in your face, you know the pain. You weren't wrong, you were just scripted in. And here's the worst part. These traps feel right. They feel exciting. They feel confirmed because they are meant to. See, the market isn't designed to fool the careless. It's designed to fool the careful, the trader who waited, who saw structure, who followed the plan. That's the one who gets pulled in, because the best traps are built on your discipline. Let's shift now. How do you avoid being cast into these scenes? It starts with understanding what real breakouts actually look like. Real breakouts aren't just big candles and high RSI. They happen with sustained volume, not just a spike. They come after true accumulation, not theatrical consolidation. And most importantly, they happen in context. A breakout at 8 a.m. GMT at a weekly high with volume made up of trapped buy stops, that's not a signal. That's a spotlight. And the moment you stepped into it, the trap was already closing. This is where the metaphor gets powerful. Breakout traders are like the audience at a magic show. They cheer when the magician says, "Watch closely," but they never realize the real trick is happening in the shadows. The right hand dazzles, the left hand deceives. So how do we protect ourselves? Here's a powerful technique: the fade the breakout strategy. Wait for the breakout, don't chase it. Watch for the retest of the breakout level. Look for rejection, weak candles, long wicks, volume dropping. Enter against the breakout. Place stop just above the high. Target the origin of the previous consolidation. It sounds counterintuitive, but that's the point. Because if something feels too obvious in the market, it probably isn't real. Here's the key psychological insight. Breakouts fail not because the setup is flawed, but because the intention behind them wasn't to continue, it was to trigger you. And that pre-breakout consolidation, it wasn't price gathering strength. It was smart money quietly loading positions, like a director building tension before the drop. And when the obvious move appears, that's their cue to act. They distribute. You enter. They exit. You fall. This is where you begin to evolve as a trader, not just by memorizing setups, but by asking deeper questions. Who benefits from this move? Why now? What happened just before? What am I being shown and what's being hidden? Because the more you zoom out, the more you'll realize every trap has a context. Every reversal has a motive. Every candle is trying to tell a story if you listen the right way. So next time you see a breakout, breathe. Don't chase it. Don't react. Don't buy into the obvious. Instead, observe the scene. Ask yourself, who wants me to believe this? What's just beyond this level? And what role am I playing right now? The strategist or the extra? Because in this theater, only one of those roles makes money. There's something strange about applause. Not the kind you hear in theaters or after speeches, but the kind that rises in markets, that collective wave of excitement, the cheer of agreement. When everyone you follow, every influencer, every trader, every friend in your Telegram group suddenly starts saying the same thing. This is the one. This is the breakout. We're going to the moon. And maybe for a moment you believe it too. Maybe you feel that little internal surge, the FOMO tap on your shoulder, and then you enter. Because it's obvious, right? Everyone agrees. But here's what most traders never realize. Applause always comes before the end of the scene. Not because the market is evil, not because it hates you, but because mass consensus is liquidity, and liquidity is what fuels the exits of smart money. Let's rewind to January 2021. GameStop, a joke stock turned movement. Reddit was on fire. Twitter was a battleground. Your cousin who's never traded was telling you to buy, and price, it soared all the way to $483. That wasn't a market anymore. That was a standing ovation. And then the curtain dropped. Hard. In 2 weeks, 90% wiped out. Theaters emptied, accounts drained. Now let's flip to October 2021. Shiba Inu. Another meme coin, SHIB to 1 cent, was trending. Elon tweeted, exchanges crashed from demand. Volume was off the charts. And under the surface, large wallets, the ones who never tweet, were distributing, not accumulating. They were selling while retail was buying the dream. The story wasn't new. The script was just rewritten. Because every time the crowd agrees, the trap is already closing. The market doesn't reward opinion. It rewards imbalance. And imbalance is created when too many people lean to one side. You weren't part of a movement. You were part of an exit strategy. Here's a question you've probably felt in your bones. Have you ever clicked into a trade because everyone else seemed excited? Be honest. Not because the chart aligned, not because your plan said so, but because Twitter said so, because the volume looked right, because the FOMO felt undeniable. And how did it end? More often than not, price reversed. You got stopped, and the silence that followed, that was the sound of the curtain falling. Let's zoom in to a specific day. GBP USD, March 15th, New York session. UK inflation data comes out stronger than expected. Cable explodes 120 pips in 10 minutes. Twitter lights up like Vegas. GBP moon mission. Retail orders pour in around 1.2450, but what almost no one saw, that spike hit 1.465, the previous month's high, a sell-side liquidity pool, the perfect place for smart money to exit, because that spike didn't confirm the breakout. It fulfilled it within hours, a 200 pip drop. Every late buyer liquidated. What happened wasn't fake. The data was real. The candle was real. But the intention behind the move was theater. This is the part that changes how you see everything. In smart money concepts, those highs and lows, we call them liquidity pools. But here's a better metaphor. They're audience seating charts. Equal highs, sold out show, equal lows, standing room only. And smart money, they don't buy tickets. They collect them. They wait until the audience is fully seated, then they change the script. Now, let's be clear. Consensus isn't always wrong. During strong trends, the crowd can ride the wave for weeks. The difference is subtle but crucial. Early consensus is quiet. It's built on accumulation, thus the move is still in its infancy. Late stage consensus, it screams, it demands you join, it tells you you're missing out. And that's exactly when the rug gets pulled. Why? Because if something is visible to everyone, it's already priced in. If it feels easy, it's bait. If it feels popular, it's late. The market loves to reward conviction just long enough for it to become complacency. And then it punishes applause. Here's a practical strategy for this moment: the consensus fade method. When social media explodes with agreement, pause. Let the initial wave of emotion play out. Watch for signs of exhaustion, declining volume, wicks at highs, momentum stalling. Then look in the opposite direction. Enter small, stop above the high, target the opposite liquidity zone. It won't work every time, but it will snap you out of being part of the crowd. Here's the uncomfortable truth: real traders don't hunt for confirmation, they hunt for conflict. They don't jump in when price feels obvious. They move when others hesitate, when the crowd is split, not unanimous. Because the louder the applause, the closer we are to the lights going out. So here's your new question before every trade: is this setup real, or is it just popular? Do I feel confident because the context aligns, or because everyone else is excited? When you start asking those questions, you step off the stage and you begin to read the timing of the performance. Because remember, the show doesn't end when price tops out. It ends when the audience stops watching. And those who exit before the final act, they never see the twist. The chart looks alive, candles surging, structure breaking, momentum rising, everything screams go. And yet, you hesitate. Something doesn't feel right. You've seen this scene before. You've been lured in by the drama only to get dumped by the punchline. So you pause and you ask the question that changes everything: is this movement real, or is it just another performance? Because once you've been burned enough, once you've watched enough perfect trades unravel into traps, you start to suspect the truth. The market doesn't move, it performs. And that shift from believing in motion to recognizing performance is the beginning of real mastery. Let me show you a moment that shattered my old thinking. Bitcoin, December 2023, 4-hour chart. Price breaks above 42,000 with authority, clean structure shift, bullish order flow. The herd calls it a breakout. Traders flood in. The screen lights up with long positions. Then the market drops back to 41,200, fills a fair value gap, stalls, consolidates for 8 hours. The crowd leaves, volume dies. They call it a failed breakout. And then explosion. 2-day move from 41,200 to 48,000. That initial push above 42K wasn't the breakout. It was the Act 1 climax. It was inducement, a perfectly timed trap designed to lure shorts early, bait longs late, and shake out everyone in between. The drop, that was a test. The pause, that was pressure building. The real move, it came when most people had already left the theater. This is the emotional choreography of price. It shows you what you want to see and then tests your reaction. Because price isn't truth, it's narrative. It tells a story, but you have to read between the lines. And inducement, that's when the story pretends to end just before the twist. Let's break this down deeper. What is inducement? It's the market creating a false sense of resolution, a break of structure, a confirmation, a clear change on the surface. But beneath it, no substance, just bait. It's a technique as old as storytelling itself. Think of a movie where the villain fakes their death halfway through, only to return stronger at the end. Think of a song that builds toward a drop only to pause in silence. That pause, that fake out, that's what gives the real moment its power. Markets do this every day. Real world example: gold, 15-minute chart, London session. Price breaks below 1950, takes out the Asian low, sellers pile in, momentum looks strong, but check the volume, it's dropping. That's your first clue. Then price recovers quickly, back above 1950, stalls, consolidates, quiet, and then a violent move up to 975. That break below 1950 wasn't bearish, it was inducement. It was engineered to trap emotional sellers, trigger stop losses, create buy-side liquidity, prepare for the real move. It's not just about what the candle does, it's about when it appears, how it moves, what it violates, And most importantly, who gets trapped when it happens. What smart money actually looks for. Smart money doesn't look at the chart the way we do. They don't care if RSI is oversold. They care if retail is overexposed. They don't ask, is this a reversal? They ask, who's stuck and how can we use them? That's where fair value gaps come in, but not the shallow gap fill version social media talks about. We're talking context-driven FVGs, because not every gap matters, not every imbalance gets filled. Context is king. A gap created during high-impact news might stay open for weeks. One formed in low-volume accumulation might fill within hours. If you're just marking FVGs because they always fill, you're reading subtitles, not the script. Market equals music. There's nuance here. There's emotion. There's rhythm. Markets operate like music. They accelerate, they pause, they repeat motifs, they mislead. Then, if you're only looking at structure, you're dancing off beat. Let's take it further. Every displacement, that sudden candle that breaks a level, isn't just price going somewhere. It's price announcing something. A displacement is a declaration, not an invitation. It's a signal that someone just took control, but it doesn't tell you why. So before you react, ask, what was price trying to accomplish? Who's on the wrong side now? Is this real movement or emotional choreography? This isn't about being paranoid. It's about being precise. It's about trading with awareness, not assumptions. The exercise that changed my trading. Every time you see a break of structure, mark it, but don't trade it. Wait, watch what price does next. Does it stall? Does it pull back to mitigate? Does volume support the move? Or was it a scene change designed to confuse? Because once you start seeing price not as truth, but as performance, you stop chasing every act and start waiting for the turning points, the moments where smart money reveals its hand, where retail gets trapped, where confusion peaks and clarity emerges. The shift, you no longer ask, where is price going? You ask, why is price going there this way? And the more you study intention, the less you fall for direction, because the chart is a stage, and every candle is a character. Sometimes the hero, sometimes the villain, sometimes a misdirection. And your job isn't to follow the action, it's to understand the plot. There's a strange silence that settles on the chart just before the storm. The candle's slow, the volatility fades, nothing moves. Retail traders call it boring, dead, choppy. But those who know better. That stillness, that's not indecision. That's the actors changing masks backstage. Because smart money never acts in full costume. It wears disguises, it plays roles. It understands that what you see on the surface isn't the truth. It's the mask they want you to believe. The market as theater. You see a tight range, no movement, low volume, feels like a waste of time. But check the dark pool data, check the block trades, you'll find millions exchanging hands, you'll find accumulation, position building, the mask of weakness hiding real strength. Case study, Tesla, September 2023. Price had rallied to 280. Then it entered a flat, lazy range between 275 and 285. No headlines, no excitement. Retail lost interest. Forums went silent. YouTube thumbnails moved on to the next shiny ticker. But the smart money, they were busy. Massive block trades, silent accumulation, the mask of boredom, the mask of nothingness. 3 weeks later, Tesla exploded to 340. Those who endured the silence caught a 20% move. Those who chased noise missed it entirely, because smart money doesn't trade based on hype. It creates the conditions for hype after they've already positioned. The accumulation and distribution masks. The accumulation mask looks like weakness, price stalls, news is negative, sentiment drops, but the footprint reveals repeated rejections at lows, large limit orders absorbing sellers, option flow stacking calls quietly. They wear this mask to accumulate without attention. The distribution mask looks like strength, price rallies, volume spikes, retail piles in 7F, but underneath, insider selling, volume divergence, delta flipping negative, bearish option flow quietly growing. They wear this mask to exit at the top into your confidence. Case study, NVIDIA, February 2024. Price hit $500. Every dip got bought. Social media screamed, 1,000 is coming, but look deeper. Insider filings, executives were dumping, call put ratio turning bearish, dark pools, heavy sells. On the surface, a parade underneath an exit plan. 2 weeks later, price collapsed to $420. Strength was just a costume, and the show already over. Unmasking with tools. Order blocks, not just zones, moments of intent. Bullish order block. Last down candle before a strong move up, real if it takes liquidity first, fake if it doesn't. Your USD example. Asian session sweep, OB forms, London session explodes. That sweep equals fuel, not failure. Breaker block, when a bullish OB fails, becomes bearish. Support resistance, mask flip, gold example, breaks above $2,000, fails at OB at 1990, collapses to 11850, the final act. Mitigation block, price returns to a level not to reverse, but to apologize, to rehearse the scene again. Bitcoin example, spike from 40K to 43K dollar, returns to 41.5K, then resumes up. The dip equals audience check. Volume profile, the audience chart. Not just lines, this is the seating map. VH, val, equals where money hides. Price returns there. It's not coincidence, it's choreography. US 30 example, price hovers at last week's POC. Retail resistance. Shorts pile in, smart money absorbs quietly. Retail gives up, boom. The mask changes, price rockets. The mindset shift. Not every quiet market is smart money. Not every rally is distribution. You need confluence, volume flow, option activity, time of day, higher time frame alignment. Amateurs look for confirmation. Professionals look for misdirection. Because smart money thrives not in clarity, but in confusion. Right before the turn, there's always fog, a stall, a pause, a strange stillness. Your new questions. What mask is price wearing right now? Is this strength or a costume? Is this drop a trap? Is this consolidation a disguise? Because when you begin to see masks, you stop getting baited by their expressions and start responding to their intentions. Trading becomes less about reacting, more about reading the role, because price doesn't lie, it acts. And once you see that, you stop being a spectator and start directing your trades with clarity. Most traders see time as noise, something passive, a ticking clock, a line at the bottom of the chart that just passes. But here's the truth. Time isn't the background. It's the stage. And the stage doesn't just matter. It defines everything. Let me explain. The same setup, the exact same price action executed at different times of day can lead to completely opposite outcomes. Why? Because price doesn't just move with structure. It moves with intention, and intention flows with timing. This hit me hard in one of the most painful lessons of my trading life. Odd USD, January 2024. Perfect setup at 11 p.m. EST. Displacement, market structure shift, fair value gap, everything aligned. I entered and waited and waited. 4 hours of chop, no volume, no progression, eventually a whimper of a move, then stop out. Frustrated, I walked away. That exact same setup appeared again. Same pair, same pattern, 6 hours later. 3 a.m. EST, London Open. Boom. One candle, explosion, 100 pips in the exact direction I had predicted earlier. The setup wasn't wrong, the timing was. And that moment rewired something in me. I stopped treating time as a container and started seeing it as a signal. Let's talk kill zones. If you study any major currency pair for just 30 days and log every significant move, you'll notice something stunning. Nearly 70% of major price moves happen during just 3 windows. London Open, 3 to 5 a.m. EST. New York Open, 8 to 10 a.m. EST. London Close, 11 a.m., 1 p.m. EST. That's only 6 hours a day. The other 18, mostly noise, range, trap, false signals, inducement. See, smart money doesn't act randomly. They operate in rhythm. They wait for volume. They wait for emotion. They wait for your guard to drop. Let's go even deeper. Have you heard of the power of 3? It's a smart money concept that explains how the market moves not just in levels, but in acts. 3 acts, like a play. Accumulation, the quiet beginning. Manipulation, the deception, the drama. Distribution, the final move, the reveal. And those acts happen on a schedule. Asian session, 7 p.m., 3 a.m., quiet, sideways. Smart money positions themselves, range builds, setup begins. London session, 3 a.m., 11 at the trap. False breakouts, stop hunts, inducement. Emotionally charged, fast-paced, high risk if you're not prepared. New York session, 8 a.m. to 5 p.m. EST. the reveal, the trend, the real move. The final act, where smart money offloads and the crowd thinks they've figured it out. This isn't theory. It's rhythm. It's intent dressed as repetition. Let me give you a textbook play. GBP JPY any week. Watch closely. Asian session creates a tight range. London Open, price spikes above that range, a fake breakout, then reversal. And through New York, the real trend unfolds in the opposite direction. It's the same play, different actors, but the script rarely changes. It's called the AMD cycle: accumulation, manipulation, distribution. And once you see it, you can't unsee it. Now let's go deeper into time's architecture. Have you ever heard of the interbank price delivery algorithm, IPDA? It's not science fiction. It's a real-time framework used by institutions to deliver price on a schedule. It works in cycles, 20-day cycles, 40-day windows, quarterly shifts. The market breathes. It expands, it contracts, it pulses, like a heart in predictable rhythms. But what is retail doing? Panicking over every 5-minute candle, entering at midnight, forcing trades at 2 p.m. on a Friday, trying to act during the intermission, wondering why nothing happens. That's the mistake. Let's anchor this with another painful truth. Most retail traders don't lose because their strategy is wrong. They lose because they enter at the wrong time. The move hasn't started. The stage isn't lit. The audience hasn't even sat down. And yet, the actor walks out expecting applause. Don't be that actor. Be the director. Here's a practical system you can use right now: the consolidation breakout strategy, time-based. Wait for Asian session range to form. Mark the high and low of the range. Set alerts at both levels. When London opens, wait 30 to 45 minutes. Let the manipulation move play out. If price breaks out and reverses, enter in the opposite direction. Stop loss just beyond the manipulation spike. Target 2x the Asian session range. This works not because of the price. It works because of the timing. You're not trading lines, you're trading acts. The real enemy isn't poor strategy, it's poor timing. Ask yourself, how many trades have I taken in the middle of the night? Because I was bored or chasing a setup that looked too good? And how many of those trades worked? This is where everything begins to shift. You no longer say, I need to catch every move. You start saying, I need to catch the right move at the right time with the right story behind it, because that's what smart money does. They don't chase every candle. They wait for the emotional crescendo, when the stage lights shift, when the music changes, when the timing says now. This is when observation beats urgency. This is when patience becomes performance. And this is when you stop watching time pass and start watching the script unfold. Dưới đây là toàn bộ nội dung bạn vừa gửi, giữ nguyên không thành thay đổi, không chỉnh sửa, không thêm hoặc bớt bất kỳ phần nào. Every great story has that moment. The theater begins to empty. People glance at their phones. Some whisper to each other. A few get up to leave. The plot seemed to stall. The energy dipped, and just when the room feels quiet, almost dead, boom, the twist hits. The real meaning is revealed. Everything shifts. But the people who left early, they never saw it coming. That's exactly how markets work, because price doesn't always explode on entry. Sometimes it waits, not because it's weak, but because it's testing you. Let me give you a trade I still think about. Crude oil, March 2024. A clean bullish setup at 78.50, displacement up, retraced to fair value gap, holding at a key support level. I entered. Everything was perfect, and then nothing. An hour passed. Still in the same zone. 2 hours. Chop, wicks, silence. I watched the candles, watched Twitter. It was quiet. Someone even posted, "Oil is dead." Eventually, I gave in, closed the position for a small loss. 20 minutes later, news hits. OPEC announces production cuts. Oil explodes to $82. My setup, my direction, everything I waited for, but I wasn't there for it. Not because I was wrong, but because I was impatient. That wasn't a loss in logic. It was a failure in endurance. Because what looked like nothing was smart money preparing, clearing the path, shaking out the weak hands, letting the crowd exit before the performance began. Let's break that down. Every stall in price action, every stretch of consolidation after a valid setup isn't necessarily a failed trade. It's a psychological stress test. Smart money knows you're watching. They know most traders don't have the energy to wait, so they bait the early move. They create a hint of momentum, and then they pause. Why? Because they want you to give up. They want to exhaust your conviction. And when you finally close the trade convinced it's dead, they begin. This is called time-based manipulation. The idea that price doesn't just manipulate direction, it manipulates tempo. It doesn't always rush. Sometimes it drags, it whispers, "This isn't working," until you walk away, and then it screams. Let me give you a name for this tactic: clearing the path. Each small push-up, a test, seeing if sellers are still there. Each minor dip, a trap, absorbing the last of retail's fear. And the silence, it's the stage crew adjusting the lights, because the final act requires precision. This isn't just theory. The volume profile confirmed it. Massive accumulation was building at the point of control, right at my original entry, but I was too impatient to see it play out. And here's the part no one talks about. Patience is more than a trait. It's an edge, because the longer you can sit through the boredom, the deeper you start to understand. Consolidation isn't indecision, it's precision. Each candle in a range is like a spring, and springs don't release when you watch, they release when you blink. So what do? You train yourself to endure, to sit longer than the average trader, to treat silence as setup, not setback. Here's a strategy I call the exhaustion breakout method. Identify a clean displacement. Wait for retrace, ideally into a fair value gap or order block. Watch for consolidation. The longer, the better, within kill zones. If price stalls for over 60 minutes with no clear rejection and volume holding steady, get ready. Enter when the first real momentum candle breaks the range. Place stop just outside the opposite side of the range. Target 2x or more of the consolidation width. It sounds simple, but the hard part, waiting. Because every minute that ticks without movement, every wick that teases your stop, every quiet bar that does nothing, it eats away at you. But if you can outlast that discomfort, you'll start to see what others miss. Because here's the twist. Most great trades don't feel exciting. They feel quiet. They feel uncertain. They feel like nothing is happening right before everything happens. Let's add one more layer. After a violent move, say a displacement or breakout, price often returns to mitigate, to test, to see if anyone still believes in the old narrative. And if nobody reacts, that's when the story begins. Think of it like a director peeking out from behind the curtain, checking if the audience is still paying attention. If they're not, the twist hits harder. That's how smart money operates. They don't chase movement. They create the illusion of stillness to shake out attention. And then, with the stage clear, they make their move. Let's anchor this with a question. When was the last time you exited too early? Not because the setup was invalid, but because you lost patience. That was smart money's final test. Because even with perfect direction and perfect analysis, if you lack timing and patience, you miss the whole performance. So here's what changes now. You begin to respect the pause. You no longer say, "Nothing is happening." You say, "Something's about to." And that's the difference between a retail reaction and a strategic decision. Because the final act isn't announced. It's quiet, it's slow, it's disguised as boredom. And it only begins when the crowd is left. Dưới đây là nội dung bạn vừa gửi. Giữ nguyên 100 không chỉnh sửa, không thêm bớt, không thay đổi bất kỳ từ ngữ, dấu câu hay cấu trúc nào. Đúng theo yêu cầu. You've studied the charts, you've read the smart money books, you've watched every YouTube breakdown, drawn every order block, marked every fair value gap, and memorized every timing window. So why are you still losing? Why, even with all this knowledge, do you still fumble at the most important moments? It's not the market. It's not smart money. It's not even your strategy. It's your script, the invisible one, the one running in the background, the one that's not on your trading plan, but buried in your identity. Let me be brutally honest with you. January 2023, I had $10,000 in my account. I was sharp. I could see inducement with my eyes closed. I had a routine, a structure, a system. But 2 months later, I was down to $3,000. And it wasn't because I didn't understand the charts. It was because I was still acting out the same emotional script I'd been following for years. Every loss triggered the same voice inside me. Double the size. Prove it wasn't a mistake. Make it back fast. I wasn't trading charts. I was trading pain. I was trading ego. I remember one trade in particular. Gold, London Open. Price swept Asian lows. Tapped into a clean fair value gap. Showed rejection. Textbook. I entered with proper risk. 1%. It went against me, 20 pips. Instead of waiting for my stop to hit, I added. It has to turn here, I told myself. It didn't. I added again. Now I was in 5% deep, emotionally hijacked, fully blind. Eventually, I got stopped out. Big loss. And of course, 10 minutes later, price reversed and went exactly where I expected. My analysis wasn't broken. My psychology was. Because even after mastering advanced concepts, I was still operating from an outdated emotional code. Here's the painful truth. You don't trade price, you trade your story about price. And if that story is rooted in fear, shame, proving, chasing, or revenge, no concept will save you. This isn't just revenge trading, it's identity protection. The market becomes a mirror. Every loss feels like rejection. Every drawdown is personal. Every missed move equals failure. You tell yourself, I'll be better next time. But next time, that same old script kicks in, and unless you rewrite it, you're stuck acting out someone else's movie scene after scene. Let me ask you something. Have you ever increased your position size not because the setup was better, but because you were trying to get back what you lost? Be honest. Drop the excuses. Because this is where real transformation begins. You can't trade clean if your self-worth is tied to every outcome. You can't follow your plan if your ego keeps hijacking the steering wheel. And you sure as hell can't find peace if every candle threatens your identity. This is where risk management becomes something deeper. It's not just capital protection, it's emotional insulation. When you risk 1% per trade, you give yourself space to think. You give yourself permission to lose without spiraling. You give your discipline room to breathe. My rule now is simple. 1% max risk. No exceptions. That means I can be wrong 20 times in a row and I'm still standing. More importantly, I'm still clear. Because the moment your risk is bigger than your psychology can handle, you're no longer trading, you're gambling, with your self-image on the line. Let's go even deeper. Sometimes you're not trading to make money. You're trading to feel worthy, to feel like you belong in the real trader club, to prove to yourself or to someone else that you're not a failure. But here's the secret. The best traders are the ones who no longer need trading to prove anything. They don't need to win today. They don't need to catch every move. They don't need to be right because they've stepped off the stage. They've stopped performing for their past. They're not trading to fix a wound. They're trading with clarity. That clarity is where your edge lives. Not in more setups, not in cleaner charts, but in calmer decisions. Let me give you the mindset shift that changed everything for me. Before every trade, I ask myself, am I trading the chart or am I trading my emotions? And if I feel any urgency, any pressure to be right, any desire to make it back, I don't trade because the market will be there tomorrow. But my mental capital, that's far more fragile. Let's flip the script. Instead of fearing missed moves, embrace them. That's not FOMO, that's JOMO, the joy of missing out. Because missing a move that didn't match your setup, that's not a mistake. That's a win. That's discipline in action. You don't need to catch every wave. You just need to catch the right ones when you're emotionally ready. Let me ask you something. Have you ever taken a trade just because you felt restless or to make yourself feel like you were doing something? Or worse, to punish the market for what it did to you last time? If yes, then congratulations. You're not broken. You're human. But now it's time to stop trading like prey and start trading like a strategist, one who doesn't need every candle to validate their worth, one who can lose and still feel whole, one who knows that mastering setups is meaningless without mastering the self behind them. This is where your evolution begins. Not in the next strategy, not in the next YouTube video, but in your inner monologue. You don't need a better entry. You need a new voice. And that voice doesn't chase, it doesn't force, it doesn't prove, it observes, waits, and then acts. And that's when trading becomes art. Dưới đây là nội dung bạn vừa gửi, giữ nguyên tuyệt đối, không chỉnh sửa, không thêm bớt, đúng theo yêu cầu. You've come a long way. You've seen the stage, you've heard the applause, you've watched the fake outs, the disguises, the delayed acts. You've realized that the enemy wasn't just the chart, it was your own script. So now what? Where do you go from here? You become the observer, not the hero, not the victim, not the over-eager analyst clicking buy at every candle, just the observer. Because before you can trade like a strategist, you need to see like one. Tomorrow morning, when you sit down at your screen, I'm going to ask you to do something uncomfortable. Don't look for trades. Don't chase entries. Don't think in setups. Just observe. Pick one session. London, New York, doesn't matter. Open one chart. E or USD, S&P 500, Bitcoin, your choice. And for the next 3 to 4 hours, do nothing. Just watch. I know. It'll feel like a waste of time. You'll feel lazy. You'll feel like you're missing something. But that's the voice you're trying to outgrow, because real progress doesn't happen in execution. It happens in awareness. So here's what I want you to focus on during that observation. Observer's checklist. Equal highs and lows. Mark them. These are liquidity pools, not support resistance. Observe how price reacts around them, not just if it breaks. Speed of movement. When does price move fast versus slow? Fast equal motion, slow is planning. Most traps happen fast. Most setups build slow. Which moves retrace immediately? These are your inducements, fake climaxes. Note where they appear and what follows. Where does price return to? These are your mitigation blocks. Price comes back to test if the audience still believes. Watch how candles behave during the return. Every hour, take a screenshot. Write a note. Label the act you think price is in: accumulation, manipulation, distribution. The end of the session, look back. You'll start seeing a rhythm. Look back. You'll start seeing a rhythm, a tone, a pattern that no indicator can show you. Market eger. Market empathy. The ability to feel what the market is trying to do, not just what it's showing. Let me give you an exercise that builds this skill even faster. Pick one pair. Set 4 alarms. Asian Open, London Open, New York Open, London Close. At each alarm, ask yourself, what role is the market playing right now? Is it prepping, trapping, releasing? Who's in pain right now? Who's in control? When you answer those questions consistently, something magical happens. You stop chasing setups. You start reading the scene. You don't react to candles. You interpret intentions. You no longer just look at what price is doing. You ask why it's doing it, when, and to whom. And that leads us to the next level, paper trading with theatrical awareness. When you feel a setup forming, ask yourself, what act is this in? Who just got trapped? What mask is price wearing? What would smart money want next? You don't enter unless you can answer all 4. And when you do enter, everything changes. Your risk isn't just 1%. It becomes theater ticket pricing. Think of it like this. A London Open setup with clear inducement and volume, that's a front row seat, worth full risk. A random Asian session chop, that's standing room only. Maybe skip the show. You start thinking like a director. Is this scene worth producing? Are the actors in place? Is the emotional tension peaking? Has the crowd committed, or is it still distracted? Even your journaling evolves. You stop logging wins and losses. You start writing movie reviews. Today's EUR USD performance featured a quiet accumulation in Act 1, then a classic manipulation spike that swept retail longs. Final distribution unfolded cleanly with mitigation retest. Rating 4 out of 5 stars. Would trade again. This may sound silly, but I promise, once you start reviewing trades as stories, your retention triples, your recall sharpens, and your connection to the rhythm of price becomes instinctive. Because the truth is, every great trader started not with execution, but with attention. They watched, they absorbed, they sat quietly while others scrambled, and in that stillness, they saw the script. You can do the same, but it starts with one hard step. Don't trade. Watch. Just one session, just one chart, just one act of full, undistracted presence. Because once you see how much you've been missing in your rush to enter, you'll never want to trade the same way again. This is the moment, the one where you stop trying to prove something, the one where you stop chasing real trader status, the one where you stop looking for setups and start sensing narratives. You're not just learning to trade, you're learning to see. You're becoming the observer. And from that role, you can write a whole new script. Dưới đây là nội dung bạn vừa gửi, giữ nguyên tuyệt đối, không chỉnh sửa, đúng theo yêu cầu. You've made it to the end. But this isn't the end of a video. It's the end of an illusion, the end of trading like prey, and the beginning of trading with power. Because now, you don't just see charts, you see psychology, you see pressure points, you see the traps, the timing, and the invisible hands pulling strings behind every move. You're no longer chasing confirmation, you're stalking vulnerability. You're no longer reacting, you're responding with clarity. You've burned the boat, you've embraced uncertainty, and you've stepped into the mind of a strategist. Not because you learned more, but because you unlearned what was blinding you. You rewired how you think, prepare, enter, exit, and feel under pressure. This was never about signals, it was about evolution, the kind no one sees. But everyone feels when you walk into a market and it bends toward your discipline. So if this spoke to something in you, if something shifted deep inside, don't let it stop here. Share this with the trader who's still trapped in setups while you've already stepped into strategy. Bookmark this video and come back, not to relearn, but to remind, because the next chapter isn't technical, it's internal, it's subtle, and it's yours to write. So step off the stage, pick up the script, and trade like the market was written for you, because in many ways, now it is.